Time now for some Squawk picks. Our next guest says the market winds are blowing in favor of the financials, healthcare, and AI sectors. Joining us now is Greg Branch, Veritas Financial Group, managing partner and a CNBC contributor. And we had to drag any bullish stock ideas out of this guy again. And so I go back and forth with you, Greg, and welcome. It's good to see you. I thought you were too bearish for too long. Then you waited till in August, the market came back to you, kind of. And but now it's made up most of those losses from that we saw from August. And now we're back in sort of a bull trend. And you still are not happy about the stock market's prospects right now. You still think this is going to end badly. I think you must think that.
Somewhat badly. And I'd actually probably turn the question back on you rhetorically, Joe.
Yeah.
What has changed since August?
I don't think we ever know near term what's changing. The market tells us what's changing. At this point, Greg, if we have Savita coming on, Subramanian, I think you've seen her on before. She's talking about 5,000 on the S&P. If we get to 5,000 on the S&P, you have missed 4,000 to 5,000.
That is
so that's like 25% at that point.
That is exactly right. And you know when I heard that before? In January of 2022, when it was at 4,700 and everyone was saying 5,500 and 6,000, and I came out with my target of 3,800.
Right.
So I will tell you what actually has changed.
Okay.
Right? And so we got a couple of unique data points, or at least that were portrayed as unique, that we extrapolated on, and I don't think that we had the liberty to do that.
Inflation, one of them? Or?
Let's hold that one for 1 second.
Okay. And
the first one was the jobs report.
Right.
We got a number that was significantly less than September's 297.
Right.
But it wasn't less than June's 107 or July's 157. And so I don't know if we can extrapolate a trend from that. And by the way, 150,000 jobs adds is a very healthy number.
But here's my question. You can flip that rhetorical question again. What had changed in August from, I don't know, 3 months prior to that, too? I don't understand the whipsaws of the ups and downs, but you can look at either one of these extremes and wonder what happened. Why now? Right.
And I think we can identify what happened in August as well. We don't know with certainty, but the yield curve started to move of their own accord. And on the long end,
because we were worried potentially about the national debt, which hasn't changed.
Right? But the yields have retreated, which is, I'm certain, giving the Fed some indigestion. They have a lot to worry about.
They liked it when the people worrying about the long term, they liked it when they bid up rates. You think that did some of the work for the Fed?
I think we all like it when somebody does some of our work for us, right? I think they're no different.
The reason I said that you think it's going to end badly is because you're talking about short-term duration fixed income. Mm-hmm. The only reason someone would want to do that, and I don't want to do that, the only reason you'd want to do that is to have dry powder for the next time things get better. Because you're a guy that manages money for people. They want to build wealth. You can't build wealth at 4.5% for 2 years or 5% for 2 years. Right. All you do is you're getting the return of your principal, but that's not really much of a return on your principal when your friends are watching NVIDIA or the Magnificent Seven. So you must think that you're going to be able to buy cheaper.
That is what I think. And you make an excellent point, and I think that that's why it's our job as professionals to make sure that we are reinforcing the long-term view with our clients. And so, yes, there are those who say, oh, Greg, we missed some upside, but they also remember that we avoided a heck of a lot of downside in 2022 as well.
Right.
There is one thing, though, and I want to go back to this, that would make me change my mind, and hopefully I get out in front of this before I've been burned too badly, but this is the first CPI report where we saw a meaningful disinflation in the housing component, right? Can we extrapolate that as a trend? I don't know. I'm going to wait and reserve judgment until we have a few more data points. But certainly if that appears to be, and there's evidence that that's going to be a trend, that will make me reconsider some of my arguments.
With all that said, if someone held your feet to the fire and said, I want to buy some stocks, you do have some things that you would buy right now versus other things that you wouldn't touch, which are?
And nothing is completely clean for me. But, the financials, I think we started to see with this quarter, the real power behind a more favorable net interest margin. And obviously, that's going to be more efficacious when the long end is holding up its end of the bargain and with the curve flattening. What gives me caution is that I do think that there'll be a provisioning cycle. Right now, that's been fairly modest, but we'll have some runway before Basel III kicks in. So I think the financials will outperform because their earnings will grow faster. I obviously think things tethered to secular tailwinds like AI, cloud, cybersecurity, and healthcare is probably the new defensive. They can pass along any increases. Their demand is not affected by the macro environment. And obviously, you got some pillar drugs at work with Lilly and Norvo. So those are safe areas where we'll get relative earnings growth. I do think breadth will narrow if I'm right.
You think that if the long end of the yield curve holds up, to steepen it, you think the short end comes down? So you think the Fed cuts before it raises again?
I don't think we need either of those things. I think that the short end can stay where it is, and as we saw last month before it started to retreat, just the long end doing the heavy lifting of getting back even with the short end and the flattening. I don't even think we need a steepening.
For the financials, even flat?
Financials to work. Yeah.
So that means the 10-year goes back above 5 then?
I think that's where we're headed.
It should, with $34 trillion in, and we do need to service that debt, don't we, how often? And there are rollovers coming across the board. Rollovers are coming in, maybe not in, I think a lot of individuals aren't worried about it, but corporations, there's going to be, with commercial real estate, there's going to be rollovers at much higher rates, right? And the government.
Yeah, and look, don't forget, just like households took advantage of those near zero rates in 2020 and 2021, so did corporations. It's one of the reasons why we haven't seen the weakness in the jobs market that we thought we would, is because they had the government transfer money to spend and because they had restructured their debt. But that has limited runway. And so I think we're starting to see on the fringe corporate delinquencies go up as some of that rolls off. And we'll continue to see that in 2025 and 2024.
What would, so you mentioned 3,800 on the S&P. What would get you to say, holy smoke, this is a screaming buy? What on the S&P? 40, you moved it up from 38? What would do it? 38?
I don't change my price targets to up.
38?
I don't chase the tape, Joe. It's 225 for next year. 17 times is 3,800.